Welcome to This Explainer. I want you to picture this for a second. A 22-year-old opens up a free checking account on their phone. It seems like a simple, totally harmless, everyday transaction, right? But behind that screen, Wall Street is quietly calculating exactly how much money it can extract from that one single individual for the next 60 years. We are literally looking at a system where a single free app download triggers a lifelong monetization plan. Okay, so let's dive right into this, because that 60-year timeline, that's the key to the whole shebang. You see, Wall Street isn't looking at a single overdraft fee or just a one-off loan. No, they are looking at an entire lifespan. They want your paycheck, your rent payments, your future mortgage, your daily coffee habit, and, of course, the debt you naturally accumulate along the way. They want to capture absolutely every financial move you make, from the day you graduate all the way to the day you finally retire.
Part 1. The Hidden Reality. From Customers to Financial Assets.
Just look at the sheer scale of the prize here. $74 trillion. Yeah, trillion with a T. According to Bank of America Global Research, that is the estimated amount Gen Z and Millennials will inherit by the year 2040. Right now, millions of young Americans are doing exactly what they were told to do, going to school, working hard, building credit. Yet despite playing by all the rules, so many end up feeling significantly poorer than their parents did at the exact same age. But honestly, that personal anxiety isn't an accident. To the financial industry, you aren't just a customer anymore. You are a long-term financial asset. And this largest wealth transfer in human history is their ultimate opportunity.
So how do they do it? Well, they target you based on a clinical, highly calculated metric known as lifetime customer value. This is basically an economic strategy where financial institutions aim to capture an individual right around age 18 to monetize their entire economic existence. Literally everything you do, your everyday debit card swipes, that car loan, and yes, especially your financial mistakes like missed payments or overdrafts, it's all mapped out as predictable future revenue. You aren't just opening an account, you're actively entering an ecosystem completely designed to hold you there.
And this is exactly why those sleek, zero-fee banking apps exist. It's certainly not charity, for sure. Research actually shows that over 30% of consumers refuse to switch banks simply because it feels inconvenient. Banks know this. They know that human inertia becomes their profit. These apps are designed a bit like a digital roach motel, incredibly easy to check into but surprisingly difficult to check out of. Once you're inside their beautifully designed ecosystem, complete with those instant transfers and tailored push notifications, that convenience very quickly turns right into captivity. The friction to leave is just way too high.
Part 2. Anatomy of the Debt Trap, an economy built on borrowing.
To really understand how this works, we've got to zoom out and look at the macro view. Over the last few decades, the modern American economy fundamentally shifted to rely incredibly heavily on consumer spending, which, in turn, increasingly depends on debt. Just look at the foundation of this borrowing, $1.8 trillion. That is the staggering total of U.S. student loan debt today. We're talking about more than 42 million Americans carrying this burden. We literally have an entire generation often starting their adult lives $20,000 to $40,000 in the hole before they've even received their first real paycheck. For banks, a student loan isn't a burden. It's decades of highly predictable, absolutely guaranteed interest revenue. But it doesn't stop with education. Follow that up with $1.3 trillion in total credit card debt. Think about it. In previous generations, a credit card was viewed as a symbol of luxury or maybe a tool for large, planned purchases. Today, because wages haven't even come close to keeping pace with the skyrocketing costs of rent, healthcare, and just everyday groceries, credit cards have morphed into vital survival tools. And with average interest rates hovering dangerously between 21% and 25%, Americans are paying hundreds, often thousands, every single year simply for the privilege of staying afloat.
So, with all that immense pressure, how do they keep you spending? Well, it all comes down to the psychological engineering embedded right into your banking apps. Behavioral economists deliberately use what's called choice architecture. They design these apps literally like digital casinos. Bright colors, instant rewards, totally frictionless spending mechanisms, and one-click loans. The easier spending becomes, the more your spending naturally increases. It's designed to trigger dopamine hits that multiply your transactions, all while algorithms quietly monetize your insecurities in the background.
Part 3. The Human Toll. Real-world scenarios. Now, let's look at how this systemic financialization actually plays out for people trying to navigate everyday adulthood. On one hand, you have Emily. She graduates as a nurse with $68,000 in student debt. High rent eats up 40% of her income, so she has to use a credit card for a sudden medical emergency, and boom, the compounding interest traps her. The bank constantly profits off her paycheck, deposits, swipe fees, and interest. Then on the flip side, you have Marcus. Now Marcus has a very high income, but inflated housing prices force him to delay buying a home. His substantial savings just sit in a traditional account earning almost nothing, silently being eroded by inflation, while the bank lends his very own money out to others at dramatically higher rates. Whether you're struggling with high-interest debt like Emily or sitting on stagnant savings like Marcus, the house always wins.
And honestly, the invisible cost of all this is absolutely devastating. Financial instability is consistently ranked as one of the strongest predictors of chronic stress. Millions of young Americans wake up every single morning feeling like they are already behind. This financial stress directly translates into real-world anxiety, burnout, depression, and a profound sense of loneliness. Debt doesn't just empty your bank account, it actively occupies your mental space, permanently changing how an entire generation even imagines its own future.
Part 4. What America risks losing. The macro consequences.
You know, this whole narrative is so much bigger than just a few greedy banks or your personal checking account. When entire generations remain financially fragile, the ripple effects damage the very foundation of American society. Just look at the societal impacts of this economic hopelessness. When young people stop believing that hard work actually leads to stability, trust in our shared institutions rapidly declines. We start seeing delayed family formation, rising social isolation, and a growing, genuinely bitter resentment between generations. A nation simply cannot remain socially healthy or politically stable if millions of its citizens feel economically trapped. Innovation slows down, people stop taking risks like starting small businesses, and democracy itself really suffers from the resulting polarization.
Part 5. Escaping the system. Reclaiming your financial future.
But here is the good news. Awareness changes behavior, and behavior changes systems. Now that you can clearly see the machine operating behind the screen, you can stop confusing debt with your destiny. Here are 5 actionable ways to build your escape plan. First, treat financial education like actually understanding compound interest and debt traps as necessary economic self-defense. Second, stop leaving your money in accounts that earn you absolutely nothing. Actively utilize high-yield savings and smarter banking options. Third, recognize and aggressively reduce your psychological spending triggers. Delete those frictionless shopping apps if you have to. Fourth, rebuild your community support networks because isolation makes you financially vulnerable. And finally, advocate for structural policy reform, things like transparent banking regulations and student loan reform. You genuinely have the power to break free from their carefully designed choice architecture.
As we wrap up, I want to leave you with one final, pretty provocative thought. Really think about this question. What happens to a country when its youth become more valuable as debtors than as dreamers? Look, banks aren't inherently evil simply for seeking a profit. But as a society, we really have to ask, at what exact point profit begins consuming our very future? If this explainer changed how you view your money, debt, and the modern economy, I highly encourage you to share it and subscribe for more deep dives, because the future of America depends entirely on understanding the forces trying to control it. Thanks for being here, and I'll catch you next time.